Welcome back to Journey Realty Group, your go-to channel for all things real estate, from home ownership tips to investment insights and everything in between. Today, we're diving into a topic that's transforming the way people invest in real estate syndication. And the best part, you don't have to buy a property yourself. That's right, you can invest in real estate, earn passive income, and build wealth without ever picking up a hammer or dealing with tenants. Whether you're a busy professional looking to diversify your income or a first-time investor exploring your options, this video is going to break down how syndications work, the risks and rewards, and how you can get started confidently. So grab a notebook or just sit back and absorb, because this is a journey you'll want to take. What is real estate syndication? Let's start with the basics. Real estate syndication is a method of pooling funds from multiple investors to purchase a large real estate asset, like an apartment complex, a shopping centre, or even a portfolio of rental properties. Think of it as crowdfunding for real estate. Instead of buying a duplex on your own, you and dozens or even hundreds of others contribute capital, and collectively, you own the asset. The beauty of syndication is that it opens up access to larger, more profitable deals that would be out of reach for individual investors. It also allows you to benefit from real estate income, appreciation, and tax advantages without managing the property yourself. Let's use a quick example. Imagine a $10 million apartment complex. A real estate sponsor, also called a syndicator, might put in $1 million of their own money and raise the remaining $9 million from investors. You might contribute $50,000, and along with other limited partners, you become partial owners of that asset. You're not on the loan, you're not collecting rent, but you are receiving quarterly distributions and watching your investment grow. The key players in a syndication deal. Now that we understand what syndication is, let's look at the people behind it. There are two main roles: the sponsor and the investors. The sponsor, sometimes called the general partner, GP, is the one who finds the deal, underwrites it, secures financing, and manages the asset. They're the real estate experts with skin in the game. Then there are the investors, or limited partners, LPs, like you. Your job? Provide the capital. You don't make decisions and you don't manage anything. You're truly passive, but still benefit from the deal's success. This structure is a win-win. Sponsors get access to capital to fund big projects, and investors gain passive income and property ownership without operational headaches. A good sponsor is critical. Their track record, communication, and execution can make or break your return. Always vet them thoroughly. How the money works: returns, fees, and exit strategy. Let's talk about the numbers, because let's face it, that's why you're here. Returns in real estate syndication typically come in two forms. 1. Ongoing cash flow, usually paid monthly or quarterly. This comes from rent collected after operating expenses and mortgage payments are made. 2. Equity upside. This is the profit when the property is sold or refinanced after a few years. Most syndications are structured to last 5 to 7 years. Let's say you invest $50,000 in a deal with a projected annual return of 8% in cash flow. That's $4,000 a year. At the end of 5 years, the property sells and your share of the profit adds another $20,000. That's a total of $40,000 in earnings on a $50,000 investment. Not too bad for passive income. But what about fees? Syndicators usually charge an acquisition fee, 1 to 3% for finding the deal, asset management fees, 1 to 2% annually, disposition fees when selling the asset. These are industry standard and baked into projects. Transparency is key. Reputable sponsors disclose all fees up front. Also, many syndications use a preferred return structure. That means investors get paid first, usually a 6 to 8% return, before the sponsor takes a profit split. It's an added layer of protection. Types of real estate syndication deals. Now let's explore what kind of properties are usually involved in syndications. Multifamily apartments are the most common. Why? They generate predictable cash flow and benefit from economies of scale. But it doesn't stop there. Syndications can also involve self-storage facilities, mobile home parks, retail centres, office buildings, industrial spaces, hotels and resorts, build-to-rent communities. Each asset class has its pros and cons. For instance, self-storage did remarkably well during the COVID-19 pandemic, while office space struggled. As an investor, you should understand the market cycle and how each property type performs during recessions, inflation, and economic booms. Passive income meets due diligence. Here's the catch. Just because it's passive doesn't mean you should be passive about it. Before you invest in any syndication, you need to do your homework. Ask the sponsor for a detailed business plan, market analysis, pro forma financials, property photos and past investor testimonials, exit strategy and timeline, legal structure and offering documents, PPM, operating agreement. You should also assess your personal risk tolerance. Syndications are often illiquid. Your money is tied up for years. And while the returns can be strong, there's no FDIC insurance. Market conditions, poor property management, or unrealistic projections can all affect your returns. Many investors start with what's sussed a 506 offering, which is open to accredited and a limited number of non-accredited investors. Others require accreditation, meaning a high income or net worth threshold. Make sure you understand the regulations before you invest. Getting started. Steps to join a syndication. So how do you actually get in? 1. Educate yourself. You're doing that now. Continue reading, watching, and listening. 2. Find a sponsor or syndication firm. Many reputable groups have newsletters or webinars. Start by networking. 3. Get on their investor list. SEC regulations require a pre-existing relationship before deals are shared. 4. Review deals. Evaluate multiple opportunities before choosing one. 5. Fund your investment. Once you commit, you'll wire funds and sign legal documents. 6. Relax and monitor. Sponsors provide regular updates and distributions. You can track performance, but you won't be involved in the day-to-day. Some well-known platforms that offer access to vetted syndications include CrowdStreet, Realty Mogul, and Fundrise, though many private sponsors also operate independently. Real stories. Let me share a quick example. Sarah, a 38-year-old software engineer from Atlanta, wanted to invest in real estate but didn't have time to flip houses or manage rentals. In 2021, she invested $75,000 into a multifamily syndication in Dallas. Over 3 years, she earned about $5,500 per year in distributions and walked away with nearly $40,000 in profit when the property sold. That's nearly a 60% return in 3 years, all while working her full-time job and raising 2 kids. Syndication gave her access to institutional quality real estate without the burden of management or active involvement. Closing thoughts. The power of passive investment. Let's recap. Real estate syndication is a powerful tool for building wealth, earning passive income, and diversifying your portfolio without the hassles of traditional property ownership. It gives you access to larger, cash-flowing assets, experienced operators, and the long-term appreciation that real estate is known for. But like any investment, it requires diligence, education, and the right partnerships. You're trusting someone else to manage your money, so choose wisely, ask questions, and never invest in something you don't fully understand. At Journey Realty Group, we believe that real estate is for everyone, not just landlords and developers. Whether you're in your 20s or your 60s, syndication can open doors to opportunities you never thought possible. If you found this video valuable, give us a thumbs up and don't forget to subscribe for more deep dives into real estate strategies. Got questions about syndications? Or maybe you've invested in one before? Share your experience in the comments below. We love hearing your stories and helping each other grow. Until next time, keep learning, keep investing, and remember, your journey to financial freedom starts one smart decision at a time.